Today we are going to talk about the fundamental thing. As a stock investor, you cannot afford not to know what ROE actually measures. You can put in a capital of $500 and it will generate profit of $100 for you. So the other choice is business B. It requires $2,000 to produce the same amount of profit. So in this case, which company would you choose if you are going to invest, if you're going to start a business? I want using the least money, making the best profit. This part we call the return, and then this part we call the capital. So basically, it's just a game of money makes money. ROE basically is actually measure this thing. Return, we say earning belongs to the shareholder, and then equity is the money belongs to the shareholder. The business C, now he used 2,000 as capital. So the return on the capital employed, he used all the money that to run the business is actually generate 5% only. But when you talk about return on equity, because equity is the money we have, it belongs to us. So still the return on equity should be 20%. Before you borrow money, you don't have to pay interest. Now you borrow this 2,500, you have to pay interest. You know that the return on equity should be less because the profit should be less due to the interest. So that's why some people, they will use another formula, return on capital employed, because the capital employed, it will include the loan, then the interest not counted already. There's another one, ROIC also. This is like a subset of the capital employed, because capital employed, you include many other things. So the numbers get more complicated. Usually what I'm afraid of is when I look at ROE is high, I don't want the company to use a lot of debt. Then the next thing I'll look at is, I look at how much more money they borrow. That is very low, then that's good. But if that is very high, then I want to look at how much they spend on interest, because not all company they have liability and not all liability cost interest. Get back to here, right? What numbers to plug, right? When you look at ROE, here's it. So I will say, if you want to have a good understanding, you Google this one called income statement waterfall chart. When you plug the return number, you plug it from the income statement. Then the equity, you plug it from the balance sheet. You search for this balance sheet breakdown, and then you will kind of like sort of find these things. Now you can visualize the things, and I want to show you some that you can actually see in more details in actually Share Investor. They put out a lot of good charts here. So for example, this one is Microsoft. So they calculate the ROA for you, net returns on the total asset employed, right? I think this is about the same as like ROCE. Then ROE is always more than 15-20%. Right, so these are the companies we want to look at. Just to recap what we have shared today, mainly I only invest in good company that has very high ROE, at least 15% and above. And then I try to look for those who are not highly leveraged. No debt is good. Net cash is even better. And if net debt, that means that debt is more than their cash, then I want to watch out the financing costs and in relation to the money they pay.